Hello and welcome to our video MacroMemo. There's plenty to cover as usual, and we'll start in this New Year's edition with a quick 2023 preview, at least a few very high-level thoughts in that direction. We'll take a moment and talk COVID and China, and those are two intertwined subjects at this juncture. We'll talk about job numbers, which have been strong. We will discuss business sentiment, which is getting weaker. We'll take a peek at inflation, which is still economic issue number one, and it's getting broadly better. And we'll also revisit some productivity forecasts we've made and just the extent to which those are, and in fact aren't, so far happening. Let's start with that 2023 preview, and this is really just in a nutshell. And so from an inflation perspective, our forecast is for inflation to not just come down, but to come down faster than the market thinks, which is good news. From an economic perspective, our forecast is unfortunately also for the economy to come down. That's, of course, a bad thing, and also more than the market thinks. So one of these things is good, the inflation story. One is less good, the economic story. Leaves a bit of a mixed interpretation in terms of where markets will ultimately focus. I will say, on the aggregate, as much as there's a good and a bad news story in what I just discussed, we are feeling a little bit better overall than we were a month or two ago. And that's in part because inflation is actually coming down as we've been predicting. So our conviction is mounting in terms of that call. And simultaneously, we're feeling a little bit less conviction in terms of the recession call. Still more likely than not, but we do need to celebrate that there has continued to be some surprising economic resilience. We should celebrate that falling inflation helps the economic story. The fact that China's economy is reopening is a very good thing for the global economy. And the fact that European gas prices have fallen is helpful for that part of the world. And so that is all helping a little bit on the economic front. It would be unusual at the end to avoid a recession with rate hikes having been as profound as they've been. So we are still predicting recession, predicting a slowdown, but our conviction again has fallen a little bit. We had been calling for an 80% chance of that. As of a month ago, we're now calling for a 70% chance across the span of 2023. Okay, let's turn from there. We'll talk COVID and China. And so just starting on the COVID file, and before getting to China, we can say that another dominant COVID strain appears to be manifesting. And so it wasn't that long ago that the BQ family of subvariants was the new dominant strain, had taken over in the US at least. I can say in the span of just a few short weeks, that story is now changing again, and it is now the XBB family that is taking over. It hasn't quite captured more than half of the new infections, but it's pretty clearly on its way to achieving that over the next month or so. And it's the usual story, which is every new strain is more contagious than the last, or at least better at getting around existing immunity. That's almost a by definition kind of thing. Doesn't seem to be any more deadly, and so I'm not sure it changes the equation all that much, though it should be noted we are seeing some increases in hospitalizations, and so I suppose there could be some second-order indirect effect on the economy from that. But the main COVID story for the moment is in China, and so China, having reopened abruptly in early December, is now racing toward herd immunity. The official numbers are not trustworthy at all. In fact, we've seen internal leaks of the true numbers, and the true numbers would suggest a really astonishing number of infections in very short order. In fact, as of the first 20 days of December, the Chinese internal estimate is 250 million people were infected, with more than 30 million on a single day. So they are racing through, the disease rather is racing through the population. That does mean, though, that the worst in terms of the rate of infection could be over the span of the next month. And after that point, the economy gets to start reviving in a significant way, to the extent that these pandemic restrictions are now significantly gone. And we think that will provide an important counterbalance to the economy in 2023. Most of the world quite weak, potentially in or approaching recession. The Chinese economy actually rebounding somewhat, having finally alleviated some of its very extreme restrictions. And Chinese policymakers also trying to help. They have lately targeted consumer spending, looking to revive that. That's been a source of particular weakness. People have been saving, not spending, looking to revive employment. The youth unemployment rate in particular has been near 20% at times, and they're looking to get that down as well. And the other policy change they've made recently is a series of measures designed to allow the private sector, and perhaps most importantly, the tech sector, to spread its wings somewhat more. And so this is all good news for China. We're still cautious on China in a medium and long run context. We just don't think China gets to grow at 6% or 8% anymore, which used to be its norm. But there is certainly some good cyclical news right now for China, and it may be a source of strength this year. Okay, on to job numbers. So North America reported its December figures quite recently, and they remain quite strong. We are continuing to see healthy job creation. The U.S. added 223,000 new positions in December. Canada added a huge 104,000 new positions. And so this is all very nice. Doesn't suggest we're seeing particular softness there. This is a point of resilience, even as other economic indicators have begun to weaken. I will say, though, do not look to the labor market as a leading indicator in particular. In fact, we did some recent work and we found that actually the first month of job losses is usually a month or two after the recession has started, not before. So you're not going to get job losses before the recession. The recession will happen first. The thing that could be useful, though, is that you generally get about 2 months of notably decelerating job creation, below normal job creation, before the recession strikes. And so conceivably we can get a signal from the labor market, but it will be in the context of below normal creation for a few months as opposed to outright job losses. So we can still look to that. At this point, we're not getting that. So we could say perhaps that therefore a recession is quite unlikely over the next couple of months. We're maybe in the free and clear through to, as it stands right now, maybe into March or something like that. I will say we are seeing a little bit of softness in the labor market in bits and pieces. The tech sector continues to lay off in a major way. Financial institutions are beginning to lay off in a notable way. It's been kind of a white-collar downturn so far, which is interesting. Job openings are falling a little bit, though still good. Quits are falling somewhat, though also still fairly high. I should say the rate of hiring in the U.S. is clearly slowing. It is now going at the slowest rate in 2 years. It's still just quite good, though. It's just not as extraordinary as most of the last couple of years. One place we are getting weakness, though, is in business sentiment surveys. And so, for instance, in a U.S. context, the ISM Manufacturing Index came out for a second straight month. It had a sub 50 reading, which means that the manufacturing sector is contracting slightly. The ISM Services Index, which represents a much bigger fraction of the economy, had been quite strong with a 56 reading. That's consistent with moderate to robust growth, and it collapsed in the latest month in December from 56 to 49. So that is, again, a slight contraction. And so, strictly speaking, these surveys would argue that both the goods and services components of the U.S. economy are slightly contracting. I think the magnitude is small enough, and the public sector is not included, such that I don't think you could quite say, therefore, a recession is happening. But it does suggest some weakness, and it does argue quite strongly that the service sector is now beginning to weaken as well, which is news. That is a new development. We still see a lot of weakness in housing. It's a very rate-sensitive sector. The National Association of Home Builders in the U.S., the sentiment survey there is very weak. It continues to plummet. It's now as weak as it was in the worst of early 2020, and it is approaching global financial crisis housing sentiment type of levels as well. And in the Canadian context, we have a weekly business conditions index that was created in recent years, and it fell pretty sharply over the last month as well. There may be a bit of a seasonal component, but we don't think it's all seasonal. It seems as though genuinely Canadian businesses aren't feeling as good either. Maybe the exception in all of this weak business sentiment is Germany's Bundesbank Weekly Activity Index, which actually has been rising recently and is the best it's been now in quite a number of months. And so the twist there is that in Europe, natural gas prices have been coming down. The winter has proven to be milder than feared so far. And as a result, the European economy is doing a little better than previously expected. I should emphasize this measure is still consistent with a fairly weak economy, but just not as weak as recently as a couple of weeks ago. Okay, let's talk inflation. So inflation is still issue number one here. It's the thing that hasn't been cooperating, at least until the last few months. It's the thing that's been making central banks raise rates so much. And we continue now to get more cooperative numbers. We're continuing to see happy inflation figures that show inflation finally coming down, which is quite a big deal. Eurozone inflation numbers for the latest month came out and showed a big full percentage point decline in the annual rate of inflation. So Eurozone starting to cooperate. Not getting a lot of cooperation from the core inflation measure, but it makes sense that's lagging. And if the example in North America is any guide, we should expect the core inflation numbers to come down within another month or two in Europe as well. What's interesting to me, though, is that further up the supply chain, looking at manufacturers, their level of concern about their own input prices has gone from being very concerned when inflation was quite high to being not at all concerned. We're not just talking about a normal level of concern about inflation. They are about as unconcerned by the prices they're being forced to pay as they've been over the last decade. And so that strongly suggests they're seeing flat, even falling input prices. And if history is any precedent, that should map onto wholesaler prices, it should map onto consumer prices, and it should ultimately take consumer inflation down with it, which is, of course, what the goal is right now. We're not seeing quite the same trend on the service side. Service inflation has been more persistent. We are seeing some decline in concern by service producers or service providers on that front, but it's still a fairly elevated level. So service inflation needs to be where we look on that front. We might be getting outright deflationary forces from the goods side. And then let me finish with a few thoughts on productivity. So we have, I would say, long predicted some acceleration in productivity growth in the years ahead and in the decades ahead. And that's been partially because of our thoughts around the pandemic itself and partially just given some longer term thoughts. And on the pandemic itself side of things, I can say that our view is that the ability to work and collaborate remotely, which has been enhanced enormously over the last few years, is something that can drive productivity forward. Commerce online has advanced significantly in recent years. Government services are being provided online in a way that just wasn't possible a few years ago. We've seen a leap forward in automation influenced by the pandemic and a lack of availability of workers and tight labor markets and so on. We've seen tentative steps towards the provision of healthcare and education online. They were not perfect in the least, but they are an important step forward for sectors that were in some ways quite stagnant. And then more generally, in setting aside the pandemic and just talking about the outlook for productivity over the long run, we really like the research and development trends and the capital expenditure trends that are in place right now. We're excited by the basic science that's occurring right now. We think it is quite conceivable that innovation blossoms from here. So all of that should add up to somewhat faster productivity growth over time. I will admit that we have not seen that in the latest data. The 2022 productivity data was awful. We actually saw the level of productivity falling in North America, and that is not a normal state of affairs. I should emphasize, though, those numbers are quite distorted. We saw productivity temporarily and very artificially spike in the early phase of the pandemic because a lot of workers were laid off, and so output was continuing, but with fewer workers, that means higher productivity. We're essentially getting the reversal of that. We're seeing companies hire back. That mechanically forces productivity lower, and yet it's really just an unwind of an artificial event that took place earlier. It is also the case that when you get rate hikes, productivity tends to be diminished temporarily, so that's probably also a dampening force. It's also the case that when you happen to have hired a lot of new workers recently, and that's what's happened recently, those new workers often aren't all that productive initially as they get up to speed. And so we think we're seeing some temporary speed bumps or some temporary headwinds. We think we will get through that. We still think that productivity growth can revive to some extent. And this is important because it doesn't determine really the financial standard of living of the average person. It also, from an investment perspective, heavily influences earnings growth. And that's a big driver for the stock market as well. Okay, I'll stop there. Thanks so much for sticking with you. I wish you again a happy new year and a great year ahead. And please consider tuning in again next time.